Perfect. Perfect. All righty. It is Thursday, July 24th, 2025. I am joined again with Morgan Holmes, and we are talking about how the one big beautiful bill impacts business owners. Morgan, thanks for joining again. How are you doing today?
I'm doing great. Thanks, Casey.
Glad to have you. Glad to have you. So, last week, in case you missed it, we talked about how the One Big Beautiful Bill Act impacts your business in terms of business taxes, things that have changed, things that were made permanent, things that have gone away. This week, we're going to talk about how the One Big Beautiful Bill impacts business owners. But since many of those upstream effects for your business, especially for the S Corps, the LLCs, do impact the downstream of your personal return, we're going to do a little bit of a refresher here. So, Morgan, from last week, what do the business owners need to be aware of that changes that have happened to the business side from the One Big Beautiful Bill?
Yeah, so the I think the thing that we need to think about as it relates to the one big beautiful bill and the tax implications of the business changes as it relates to the business owners, and specifically business owners that are Schedule C or sole proprietors, or business owners that own rental properties. So some of those benefits that typically you think as a business benefit are benefits to individuals, like bonus depreciation. So bonus depreciation post TCJA has been sliding down, or decreasing by 20% a year, to where 2025, pre the One Big Beautiful Bill, was 40% of the assets placed in service. With the One Big Beautiful Bill, bonus depreciation is back to 100% for assets that have been placed in service after January 19th, 2025. So if you've purchased fixed assets on January 20th, computer equipment, furniture, qualified improvement property, or anything like that, we're back to 100% bonus depreciation. So it's a retroactive depreciation change.
That's awesome.
Additionally, Section 179 has been increased, so almost doubled. So again, it's Section 179 is a depreciation or an election to accelerate depreciation on assets, similar to bonus depreciation. So that's been increased. The qualified business income deduction, which was set to sunset with the Tax Cut and Jobs Act on December 31st, 2025, has now been made permanent. So now we'll have the qualified business income deduction after 2025.
That's great.
And then not that we're going to see this a whole lot with sole proprietors, but the capitalization of R&E expenses has now been changed to, instead of capitalizing both domestic and foreign research and experimental expenses, you only have to capitalize the foreign R&E expense. So that's a positive change, and even more positive for small businesses, because you can actually go back and amend your prior year's tax returns to deduct the R&E expenses from 2022 and 23 and 24.
So that means money could be coming back. Simple, right?
That is right.
That's good. That's good. That's what the people like to hear.
That's right. Refunds are always good.
Got it. Got it. Now, anything else on the business side, especially on the S Corp, anything else that we're missing that impacts the business owners on the individual side?
I mean, there's small nits and gnats, but I think those are probably the big pieces. So, obviously that income flows up to the individuals, and that's what we're going to talk about today, is the One Big Beautiful Bill and the individual income tax implications.
Now, with the One Big Beautiful Bill, let's talk for the individuals. What was made permanent before we start talking about what's new? What was on the chopping block that was then made permanent? For instance, like the standard deduction. What are some of those things that they said, hey, we're going to keep this and extend permanently?
Yep. So with the Tax Cut and Jobs Act that was passed in 2017, the Tax Cut and Jobs Act was set to sunset on December 31st, 2025. It included things like an increase, like you mentioned, the increased standard deduction, the lower income tax rates, right? So the pre-Tax Cut and Jobs Act, the highest individual income tax rate was 39.6%. Tax Cut and Jobs Act brought that down to 37%. That was supposed to sunset on December 31st, 2025. That's now been made permanent. Personal exemptions, pre-TCJA, we were able to take deductions for personal exemptions. TCJA eliminated that, and the One Big Beautiful Bill extended the elimination of the standard deduction. So, yeah.
Got it. That's definitely good for the individual. I know standard deduction much higher than it was pre-TCJA, so
That's right.
glad to have that stay. Anything else? Anything else that was made permanent that's stayed but made permanent now from
Oh, well, I mean, I
TCJA?
mentioned the qualified business income deduction, so
That's right.
that was made permanent. Yeah, I mean, those are the big things. I mean, a lot of stuff was going to change, and specifically the biggest benefit is the continuation of the reduced tax brackets.
Got it. Got it. Now, what everyone's probably so eager to hear, what was new? What has been added? What are some of the changes?
Yeah. So there's quite a few as it relates to individual income tax implications. One of them, or two of them actually, that came from the Trump's campaign was the no tax on tips and the no tax on overtime. So those have been passed and are included in the One Big Beautiful Bill. If you're receiving tip income or overtime pay, you can exclude up to $25,000 of that, subject to certain limitations on your adjusted gross income. So that's a positive thing. Itemized deductions, again, the TCJA, TCJA eliminated the miscellaneous itemized deductions. One Big Beautiful Bill continues the elimination of the deduction for miscellaneous itemized deductions. The increased child tax credit. So it was $2,000. It went up to $2,200 as part of the tax or the One Big Beautiful Bill. The 529 plans, the ability to pull out of 529 plans and use that for other than college. So you can use it for K-12 private tuition. I think you have to be careful there, though. Some states don't necessarily conform to the One Big Beautiful Bill or Tax Cut and Jobs Act. So even though on the federal side, if you pull money out, you won't be penalized for taking it out of your 529 plan. That may not be the case on the state side. So be careful with that. The deduction or deductibility of interest expense on the purchase of a new vehicle. So if you purchase a new vehicle that, and again, it's subject to certain limitations, you can deduct up to $10,000 of the interest on your loan. That vehicle has to be, similar to some of the EV credits, has to have a final assembly in the United States. So that there's certain criteria that have to be met, including an adjusted gross income threshold. Some of the negative things, I guess you can consider them negative. Negative if you're going to go buy an electric vehicle is that the electric vehicle tax credit is being removed.
Most of the energy credits have been pretty much are being removed, and I know that's a big topic of talk, but they've been in since 2008 at least, somewhere around then, 2010.
Yeah,
I don't know exactly,
for a while. But I mean, the Inflation Reduction Act, as it was signed by Joe Biden, actually made it even more difficult to claim the electric vehicle.
Yeah.
Especially if you were a high income earner, you would get phased out of actually claiming that credit anyway. So now it is going to be totally going away on September 30th, 2025. So residential energy credits. So with the Inflation Reduction Act that was passed a few years ago, individuals were allowed to take a $1,200 per year tax, or up to $1,200 per year tax credit for things like installing new windows, energy efficient windows, energy efficient skylights, anything that's residential that's energy efficient. You could claim a credit on that. Also going away. The 30% tax credit on solar panels for your home and the battery installations, if you're doing that, also going away.
Got
So
it.
yeah, the renewable energy implications are not positive. So
Gotcha.
you were going that way. Just if you're thinking about doing some of that stuff, or you're doing a home remodel project, make sure that you get it done pretty soon here.
Yeah, this year,
Yeah,
as soon as
yeah,
possible.
exactly.
What about on the deduction side? I know there are some changes for seniors, SALT deduction.
Yep, yep. So the SALT one is actually a big one for those of us in California and in New York or any state with a high state tax. But the SALT cap has been increased from $10,000 to $40,000. Again, it
Huge.
also has limitations on the ability to do it, but that's a great benefit for those in higher tax states.
Absolutely.
For seniors, there is an additional deduction, I guess, kind of like additional standard deduction of, I believe it was $6,000. So yeah, that's good for seniors. It also has AGI, or adjusted gross income limitations. So if you have a couple making more than $150,000, then they likely would be able to claim that additional benefit. So
Got it. What about these Trump child savings accounts? I know that's a little bit of a topic here, and I've heard some people chatter about it. That starts in 2026, right?
it does. It does. So the annual contribution limit on the Trump accounts is $5,000. The government, the federal government, will be making one-time contributions of $1,000 to accounts for children that are born between 2025 and 2028. So that's also a great way to get your kid to start building up a little nest egg.
Now, does this differ from a 529? Are they interchangeable? What changes does this have between that? You could still have both, right?
Correct. Totally separate.
Got it. That's awesome. So I think it's obviously taking advantage if you're in the I almost said in the market for having children. If you're in the process of planning to have kids, that's probably the right way to say
That's
it.
right.
Just make sure, yeah, you look at what options are available for you. Anything around child dependent care credit, anything around there, anything we want to talk about besides what we already covered?
Yeah, I mean the child and dependent care credit has been expanded, so it makes it a little easier to claim that credit. But
That's
yeah,
good. Anything else? Are we missing anything, around deductions, anything around vehicle, home, education, any other reporting?
yeah, I mean there's lots of stuff. The employer contributions to student loans. So your employer can make a contribution to your student loan to pay down the principal and interest on that. That's going to be adjusted annually for inflation. Yeah, I mean there's quite a bit of stuff, but
And that's deductible for the business, correct?
correct.
That payment per.
Yep, yep. I mean pre One Big Beautiful Bill Act, companies could make a contrib or can help you with education. Like for example, I got my master's degree in my prior firm.
Oh, Morgan froze for a second. Oh, we lost Morgan. Hmm. Standing by. We'll be right back. Alrighty. Morgan,
Never,
you bet.
never fails, right?
Never fails. Something's got to go wrong.
The only thing that fails is technology.
There you go. Um,
Can you see me?
I cannot see you. I don't have video.
Yeah, I don't know what's going on here, but
Let me take a look here.
how about now? I jumped to my laptop since my
Now I got
desk,
you.
or I jumped to my iPad since my desktop computer is having technological challenges. So sorry about that.
Gotcha. Yeah, no worries.
Where were
So
we?
we were talking about, honestly, I don't remember.
Um, some of the other things, on the individual side that have been made permanent, that affect individual taxpayers or business owners is the mortgage interest deduction limit. So, with the Tax Cuts and Jobs Act from 2017, mortgage interest has been limited to the first $750,000 of your mortgage. So, while that seems like a big number in California, it's actually not that big of a number. So many of us here in California and probably New York too, are subject to those limitations. That was made permanent with the One Big Beautiful Act as well. So those that have mortgages over $1 million or over $750,000, their mortgage interest is going to be limited. So
Gotcha. Yeah, I know on a completely other note, but some of these business owners and some of the MSPs I talk with, the wagering loss deduction limitation. I know there's a lot of controversy around that with the phantom income that can happen because I know you can only deduct 90% of your wagering losses now.
that's
So
right.
definitely
Yeah.
challenges with that.
Yeah. I guess if you're a gambler.
If you're a gambler, which I do. I'm more of a casino advocate, little sports betting. I'm nowhere in this, but if you're that type where, let's say you gambled 20,000 of winnings and you also had 20,000 loss, so you broke even, you technically still owe tax on that 20,000 of winnings up to the 90% that you deduct. So you owe $2,000 worth of income is taxable. So
Yeah.
it's interesting, but I know they're already trying to propose new legislation for that. I just figured I'd throw that out there. It's a little
Yep.
interesting. And then
That's definitely, for those that go to Las Vegas for conventions and you
yeah,
gamble, you could end up with a tax bill. Historic, pre One Big Beautiful Bill, you would be allowed to take a deduction for your gambling losses up to
yeah,
your gambling winnings, and that's no
yeah,
longer the case.
yeah. So unfortunate, but I'm sure it'll get adjusted, and if anything, it'll just promote gamblers to make sure they lose enough. I don't know. It's
Yeah,
that'll be what it is.
yeah. But I when I gamble, that's typically the case anyway. So.
There you go. Now, charitable deductions expanded for non-itemizers. I saw that. That's a good one for the individual.
Yeah. So with the CARES Act back in 2020, I believe it was, because of COVID, individuals were allowed to take a deduction for charitable contributions that they had made, regardless of whether they were non-itemizers or itemizers.
Mhm.
That went away in 2022, I believe it was, and is
Yeah.
now back to where you can take a deduction up to, I think it's $600 if you make a charitable contribution for a married couple, and take a deduction for it, regardless of whether you're itemizing or not. Charitable contributions now are maybe slightly limited for itemizers, and that you have to reduce your charitable contributions by 0.5% of your adjusted gross income, or I think they call it like a some sort of base or something. But yeah.
Gotcha. Anything else, Morgan? I know we've talked about quite a bit today. We're getting close to the mark here. I'm just curious if there's anything else or what business owners should be saying, okay, what do I need to do now to take this information and apply it to my business or my individual taxes?
Yeah, I mean, I think the thing that people need to think about is what implication the One Big Beautiful Bill has on their 2025 tax liabilities. Obviously, the One Big Beautiful Bill got passed in the middle of this year, right? But some of these provisions are retroactive, specifically bonus depreciation, right? So, you know, if you have a rental property or a sole proprietorship and you've been acquiring fixed assets, the depreciation on that has been, you know, the bonus depreciation piece has been limited, you know, up through that. Now we are back to 100% bonus depreciation. So
Yeah.
if you've been making estimated tax payments, assuming that your depreciation is lower, you need to start looking at what you've paid in relative to what you potentially owe now as a result of the one big beautiful bill. So yeah,
Got it.
I would say just start talking to your tax advisor about the 2025 implications and as they relate to your personal liability and your business liability. So
Absolutely. The same old message, people, when it comes to tax. Don't wait till tax season. Talk to your CPA throughout the year. Get a tax advisor who can build an actual plan and a strategy and can take a look, fine tooth comb through your individual situation, because everybody's tax situation is a little bit different and there's different rules that apply. So it's a proactive way to help support your cash flow. Morgan, anything else for the viewers before leave it here today?
yeah, just again, I think your point of getting in front of your tax advisor and starting to do some planning, even though we're only halfway through the year, it's never too early. So
Yep. All righty. Well, Morgan, thank you again for joining us. We'll be on the road next week. We're going to be in Channel Con for those MSPs that'll be in Nashville. Come say hi. Booth 603 for Stride. We're excited to talk about you. And, you know, I'm sure Morgan will be happy to talk tax with you there also.
absolutely. And sorry again for technological challenges. So
No worries. No
I'm
worries.
sure it won't be the
Thank you,
last time.
Morgan. Thank you, Morgan.
Thank you. Have a good one.
You too. Bye.
Bye-bye.
All right.